our topic of today, which is charitable remainder trusts. It's actually a topic that has come into conversation with some of my clients, what to do with gains they have generated over time, and how to pass on wealth to either charities or to beneficiaries. So, in the long run, it may likely to work out, but there are some risks. So I actually wanted to ask you, how would you explain what a charitable remainder trust is?
A charitable remainder trust is a trust-based strategy. It refers to quite a few types of trusts, honestly, but it's a trust-based strategy in which you can pledge an asset to charity, and you can avoid the capital gains of selling that asset by doing a pledge and by transferring that asset to a trust. And then the interest in that asset is then split up. That doesn't make a lot of sense if you've never seen it before, but the interest is split into a remainder interest and an income interest, and you can keep the income interest. So in the example of a portfolio, let's say make it really easy and you just use a dividend paying stock. I don't know. What's a dividend paying stock? AT&T.
Or British Tobacco.
If you take British Tobacco, let's say you bought it very cheaply over a long time period, you transfer it into this trust. The trust has the remainder, or a charity has the remainder interest. You have the income interest. The dividends are functionally yours to pay out. So you can keep those in the trust. You can keep those yourself. And the principal stays in the trust. And at the end of the trust life, will go to a charitable beneficiary. So it's really just about splitting up that income and remainder interest in an asset. And you could do it with all sorts of assets.
I think there's an image. I'm looking here at one of the websites from Fidelity, and they have a really good image that kind of explains that.
So this image shows an individual makes a contribution to the trust. The individual gets a partial tax deduction in the income stream. Yep, makes sense. And then the remainder amount goes to your charities. That makes sense to me. There's a lot of details in this, but you do get a partial tax deduction. You get to avoid the sale of whatever asset that is. That's really the key piece, is that instead of selling this and giving it to your trust, you make the contribution of assets into the trust.
So basically the charity is the one selling the trust, or they're giving it to charity?
The charity is the remainder beneficiary. So at the end of the trust lifetime, which is set in the trust documents, the charities are going to receive whatever is left over.
It says here that the beneficiaries could receive the income stream, right? How do you determine the income stream?
Yeah, there's a few ways to do this, and it has to do with the type of CRT that you set up. There's a very simple way that's based on current interest rates and IRS tables on mortality that are very simple and straightforward. So you can do that to where at the end of the year, it's basically a flat calculation. They'll say, okay, 7%, for example, is the payout rate, and you calculate the asset total value at the end of whatever the last year was, then the trust owes you 7% of that asset value, and you recalculate that each year.
Is it based on life expect? What was it based on?
You can do it based on a term. You can do it based on life expectancy. And there's also a way to get a little bit fancy with it and do kind of a catch-up provision, depending on your planning needs, to where the trust kind of owes you future income benefits, but they just accrue over time and are not actually paid out immediately. That can help in situations like, for example, let's say you put startup equity into your CRT and you don't have liquidity, you can't sell it. You can make the trust functionally owe you future income that's calculated based on that value.
So essentially, they're paying you like an annuity. The Charitable Remainder Trust will pay you an annuity after you deposit those assets for a specific time period.
That's right, but there's flexibility in how you can set up that annuity income stream. You can make it very simple, straightforward, 20-year term. You can make it lifetime term. You can do these catch-up provisions. There's a good bit of kind of detail in there that's worth working through.
Somebody explained me that the Charitable Remainder Trust, the reason why it's not really, when you give the money to the Charitable Remainder Trust, it supposedly is taxed, but what you're receiving in exchange for giving the money to the CRT, which is a different entity, right, is the equivalent in annuity income, right? That's why that exchange is kind of nullified, because it's the same. You're giving something, you're getting back the same value, but in annuity. You're just calculating in a way that the IRS deems it acceptable.
That sounds like the way that a tax attorney would think about this from like a very high structural perspective, right? Like, is the IRS giving themselves a bad deal by doing this? That argument says no, not really, because you're doing a swap, right? You're doing what might be a fair swap.
Yeah, but my question is, when the CRT essentially sells the assets, because they have to sell the assets to fund that annuity, right?
Correct.
When they sell those assets, they have to pay taxes, right?
They do not. That's the beauty of this whole thing.
So explain that to everybody.
The CRT is a new entity that you set up. So just like you set up an LLC, if you've ever done that, or a trust that has its own employer identification number, a CRT is set up in a way that it is a tax-free entity itself, because the remainder is pledged to charity. And so it has a very specific mandate and charter to where any activity that happens inside this trust, whether it's selling that highly appreciated asset, or whether it's dividends, income, or capital gains generated from the investment portfolio afterwards, the entity itself, anything that happens inside the wrapper of that CRT is tax-free. It's the distributions paid to beneficiaries, income beneficiaries, that are not tax-free.
And the reason why people do this, like the main benefit, is essentially for whatever beneficiaries to receive an income stream, and that your charity of choice gets an allocation or gets some money, right?
Correct. That's a huge benefit. I also think that psychologically it's a really big benefit, because it helps people. So like, if this is your first highly appreciated asset, let's say it's your company stock, or a piece of real estate, or a cryptocurrency, you can do it with that. It really helps people's mindset change from, oh, I've got this pile of money. Oh, I've got, $1 million. And if I sell it, I pay this huge tax, to, okay, I can really translate fairly this amount of money into this amount of income. And that's a hard problem. That's like kind of why you and I have jobs. We're financial planners. We help people turn bases of assets into income and plans and job replacement and education costs and all these things. So this is a really good, it's just one of my favorite teaching examples for that. And I want to give a shout out. One of the reasons I've been looking into this topic lately, re-interested by it, is a company called Valor. It's VALUR.io. I got to speak to the founder. His name's Manny. He's a super sharp guy, former McKinsey, went through an exit himself, and he studied the hell out of CRTs and then launched a startup that's very software focused to help people both evaluate and implement CRTs in a straightforward way. He found, as you would imagine, a ton of inefficiencies in the market for them. So I really like what Manny is doing. Disclosure, I'm working with him on them, like on CRT projects right now. I'm betting that he's going to do an awesome job, but their calculator in particular, if you go to valor.io and start playing with that calculator to say, okay, this is where I think my tax rates are. Here's how big of a gain I'm facing. And here's how I could translate that into income. That, especially if what I'm saying sounds very abstract, it's just such an awesome way to see what's going on there. Let's do a really quick one. Do an example with, whatever comes to mind, and share your screen.
So where do I live now? I live in New York. What is my age? I'm 38 years young. Equity. What's the primary asset for planning for? Equity in a company. Cost basis. What should we say? I'm just going to give whatever example here. Like, let's say it's, what should we say? 250.
Sure.
Expected value to exit. No, man, I'm I'm holding for 50. Is this 50? Yeah, 50 million.
50 million. Lordy,
Yes.
all right.
I don't know. Which one would you do? I haven't thought about this yet.
I prefer the one that's in blue, a growing share of my assets every few years. I think as you walk through this, you're generally going to see the system guide you to the max after-tax payout. Exactly.
Yeah. So essential, talk to us, after-tax payout. Oh, this is for lifetime. What happens if I do term? Okay. What was NIMCRUT? I remember hearing this.
Yeah, a NIMCRUT is, I think this is the one where a recalculation over time and you have the ability to kind of defer payments in certain periods.
Yeah. I wonder if this amount calculates also with the remainder. Yeah, this is interesting. Like actually the numbers probably work out. PV. Yeah.
I think the key to the numbers working really well is actually in the investments that you choose inside of the trust, right? Like the performance of those investments is absolutely crucial. So they do have to make, like this calculator is making assumptions. I don't think they're overly aggressive, but one could argue in different ways for that. But regardless, really interesting calculator and should hopefully get your mind running on translating a big capital gain into a stream of income.
But yeah, this was very helpful. Is there anything, like what are other things one should know about the Charitable Remainder Trust?
One just final tip that I'll leave you with is that explore Valor and talk to them if this is one that's applicable to you for sure. I would also say that in general, you probably don't need to pay, $8,000 or $10,000 to an attorney to draft a charitable remainder trust anymore. I think that's what you're going to get quoted, depending on who you ask. I think it could go higher too, and I don't think that is strictly necessary anymore. I think that there's a democratization of information and trust documents happening, and you don't have to pay a law firm a huge amount of money to draft this. That doesn't mean don't pay for legal advice or don't get lawyers involved when they should be involved. But I'm of the opinion that this can be done cheaper, aided by technology.
I think that's true. I mean, we're seeing that with everywhere. I just think that because there's a lot of flexibility, right? You can either do a fixed dollar payout, I think, or a percentage of the remaining assets of every year, right? So there's a ton of flexibility, so you can actually craft the plan that you need or want within this. But I think this is actually really meant for those who have enormous amounts of capital gains, founders specifically. Potentially, if you're coming from a tech company or any of those companies have done an IPO, these are people who have hit it big, right? So
I think that the number, like the minimum number at which this is economical is coming down, but I think it's still well into the six figures. This isn't for, your $40,000 capital gain. It's not going to make sense to set up a trust and go do that. But into the 6, 7, 8 figures, it starts to get pretty interesting, pretty economical. And again, my favorite part is the mindset shift that people go through when they start to realize, okay, this asset base can really turn into income, and here's how.
Yeah. And then the other part is that you have to be more or less charitable inclined, right? Like that's the idea.
You ought to be, but there's calculators that say that it's a net benefit to you regardless of the charitable intentions.
I would disagree there. I would say it's a net benefit if your time frame is very long, right? So at the end of the day, I think it's always safer if you are charitably inclined because you will see dual benefits. If you have a very long time frame, it might be just very economically beneficial. So that concludes our topic for today, which is CRTs on a high level and the benefits and the pros, and some resources that you're providing to the audience.